super guest today is Ian Knowles, a venture capitalist entrepreneur from New York. And this is now for you, Ian, if you want to introduce yourself.
Hey guys, yeah, as Alistair said, I'm an entrepreneur venture capitalist of sorts, based out of New York. I have a couple of different ventures that occupies my time on any given day, from a middle market private equity consulting firm down to an early stage venture capital firm. So we can, if you want, Alistair, I can go through some of the details of all of those entities now, or if you want to wait, we can do that as well. It's, you just let me know and I'll take the cue from you.
Yes, so I'd say, maybe give, you have your bio. Maybe give us a short bio. I know you've done some quite incredible things, so let us know. Yep.
Yeah. So, I early on in my life, I'm a young guy, but, I'd always wanted to be an entrepreneur, but had a lot of different ideas and, always had an interest of in building businesses, and essentially capital is just a function of innovation. Money doesn't have any personality, so it's what you do with it that's important. And understanding how money can drive growth and drive innovation is an important thing. So, early on, I made it a point to understand the value of innovation with money and without money. And and got myself aligned with. Because my first career was at a small placement agent, a marketing hedge fund and alternative asset marketing firm that raised institutional assets for private equity and hedge funds. So I got to see that world up close and personal for a few years. At the same time, I always had a very, I think, this indelible passion for culture and food and everything in between. And I'd always cooked professionally growing up. So I actually worked at this firm during the daytime and then moonlighted as a chef. And having the balance of a very nitty-gritty blue-collar culture-driven world versus the sort of the stoniness of the investment world, private equity and hedge funds with big money, big dollars, big personalities, big egos, great pedigrees, etc. It was a very I think formative experience for me to have that polarity in my daily life for a handful of years. So at the time, I was very interested in food and beverage, and I had this idea that I wanted to go out and start my own fund so I could invest in businesses. And I had experience. I started a clothing company when I was in high school, and I started a beverage company when I was when I was 18, 19, and got to know a lot of people in the beverage space and food space and in the investment world just through my travels. And took my concept out to the market. And this was my first real foray at fundraising, and myself taking it out as an entrepreneur and putting myself out there on the line and getting the feedback as a young guy. And the concept that I had was essentially to consolidate the retail wine market. So I had identified that there was no consistent experience in drinking wine or purchasing wine nationwide. And at the time, I was actually 1 year too young to drink. I was 20 years old, and I took this concept to everyone. I said, hey, look, if I'm in Chicago and I want to buy a bottle of wine, I can't have the same experience or the same benefit from having a relationship with a wine store in Chicago as I would in New York or Los Angeles or anywhere else, or benefit from that. And from an operational point of view, at that time, there's nobody who had the purchasing power, the leverage, the unified identity of one common brand, the data that you get from having a nationally scaled organization, etc. So it was a really incredible learning experience for me, and basically had a lot of people come back and say, "Hey, look, great idea, great concept, but this is a huge undertaking," and which it is, and that's sort of my emphasis on the ambition is that it's really important to at least take yourself there, put yourself out there, and understand what your limits are. And I think, obviously, from my perspective, it's really just what's up in your own head as to what your limits can be. So that's kind of what started me. And obviously, I didn't end up pursuing that. The wine market is too fickle. It's too seasonal. It's too weather dependent. Its margins are very slim if you're if you're not careful. And you really, really, really have to understand the space. So there's a lot of education that comes with it as well. So that's what got me out. And then since then, you know, I helped launch Lucas Brand Equity, which is a middle market private equity firm specialized in health and beauty. So we've got a portfolio of 8 brands there. In 2013, I founded Spruce & Norton, which is you know, what I call a modern investment development company. And the thesis for Spruce & Norton, which is really more of a philosophy, a life philosophy that I have, is that there's this mystique around venture capital, around investment, and then around entrepreneurship. And I don't think for an entrepreneur, those things are really connected. Anybody who has taken the time to go and sit in an investor meeting, a lot of times it's just a grill session. They're just grilling you. There's no rapport. There's no understanding. They don't really care where you come from. They want to know who you are, you know, who you know, and you know, how your concept's going to make money for them. Really, you know, that's kind of the general dynamic in an investor pitch, and it's really uncomfortable, I think, for a lot of people. And taking it back to what I was saying about capital simply being a mechanism or a function of innovation and growth, understanding that from the entrepreneur's point of view of how what they're doing could potentially create value, which in turn is then reflected in dollars, can help you understand how you can position yourself when you're going to talk to an investor. So that was the founding philosophy of Spruce & Norton. And if you go on our site, you'll see, you know, some of that philosophy laid out. And it's really important because at the end of the day, we all are individuals who are entitled to, you know, our own ambitions and our own passions. And there's always going to be guys out there who shoot you down. But you got to go charge it and make it happen. Sorry, go ahead.
So Spruce & Norton is an investment firm, right?
Yeah, so it's an investment development company, yep.
And so do you guys focus on special markets?
Yeah, we right now we're primarily focused on food and beverage. So we've got you know, a few deals going on in the beer space. You know, we helped finance a brewery last year in Nashville. We acquired the North American rights to an Italian brewery that we're going to be launching in Q2 here in the States.
Okay.
We're right now actually in the process of launching a fund, a holding company to invest in growth stage and then venture stage food opportunities, in which we've partnered with an incredible operating team, where you know, where I was asked to be a co-founding senior advisor to the firm. So we came together and put this joint venture together between Spruce & Norton and their firm.
Excellent, excellent. So Ian, few questions, I think, you know, to start really from the basics, because I think many of the people here might not even know necessarily, you know, what's, you know, we hear a lot the name venture capitalist, you know, but people don't necessarily have an understanding of what it is. What happens in a day of a venture capital? Tell us, bring us to your world.
Mm-hmm.
How does a week look like? You know.
Sure. Well, it's kind of crazy. You know, I think the venture capitalist, you know, name has sort of taken on a life of its own, and you know, in a lot of ways, I don't necessarily identify with it because I think it's, you know, it's been muddled a little bit, just given you know, given the tenacity of a lot of venture capitalists who sort of come off as cold-blooded or sharky. But you know, it's really, to be a venture capitalist is really to understand a lot of different things and how they all work together. And at the end of the day, you know, the goal for an investor or a venture capitalist is to make, you know, is to make an investment, not only an investment of time, but an investment of capital into in an entrepreneur or in a few entrepreneurs who have an idea that they think is going to ultimately flourish. And
So I have a question, you know, how many entrepreneurs, you know, contact you every day? How many, you know, sort of leads, you know, a venture capitalist receives generally, you know, because entrepreneur doesn't necessarily know those facts. You know?
Yeah. So it depends on how accessible you are. For my, you know, I'm a pretty accessible guy, so I end up getting a lot of people reaching out and a lot of inbound leads on a daily basis. I mean, we're looking at deals all the time. You know, and what's important I think for an entrepreneur to understand is that there are a lot of entrepreneurs out there. So when you're thinking about approaching a venture capitalist, you can almost look at it like you would approach putting a resume out there for a job, right? If you just send out a resume, right, and in this instance, the resume is sort of analogous to a pitch deck. If you just send it out to a bunch of employers, the likelihood of you getting something back is going to be slim. What I find valuable is that when an entrepreneur reaches out, I would tell you, I'm going to be honest, 99% of the time, I'm not going to respond on the first email for the sake of me knowing that an entrepreneur who actually really cares is going to follow up, right? You're better off taking a concentrated bet on 5 or 10 guys or firms, following up, staying persistent, making sure you're top of mind. And it might take 3 or 4 or 10 or 20 emails. Doesn't matter. It'll take a lot. But you're better off doing that because then they see that you're persistent, that you care. From a venture capital side, it's sort of similar to, you try and get co-investors on a deal. If I float a deal that we're working on to 100 investors and I only do it one time, I'm not going to get anything back. They're going to know, most of the people aren't going to see it. And then the other investors will ask, well, how many people did you float it to? And you'll say a lot. And they'll say, how many people invested with you? You say none. And then nothing happens, right? So it's sort of the same thing on either side, and understanding that you're better off being concentrated and consistent on a few guys than just sending out a pitch deck to 100 firms.
Yep. That's a very good insight. I think it's a very good insight. Yeah.
From my perspective as well, because we have deals that we want other strategic investors to get on with us. It's the same thing. Even if we have the warm relationship, venture capitalists are so busy. A lot of times these firms are very small. Just a few guys, 4 or 5 guys, and managing anywhere from 20 million to $20 billion. And you can imagine how many people are reaching out and sending them stuff. So you really want to stand out and show that, hey, I'm here to stay. I'm not giving up. I'm going to be, I'm an entrepreneur who's very passionate, and here's why. Otherwise, you end up just not having a face or a name. And, as an entrepreneur, that can be very discouraging if that happens too long.
Yep. So persistence is key.
Yeah.
Yep.
Yeah. Very, very important.
And then, just to get an idea, you arrive at work, is it a lot of meeting entrepreneurs, looking at business cases, looking at, and tell us about meetings,
Yep. So, day in the life will usually consist of, a lot of meetings, a lot of phone calls, a lot of casework where we're actually analyzing a market or analyzing an opportunity, weighing the risks, weighing the rewards, and seeing where the white space is, where a particular opportunity fits. So, it's usually a combination of those things. And then a lot of times, I'm an operator as well. So a lot of times we're actually in there, getting nitty gritty, working with these entrepreneurs to look at where the opportunities are, where we can be more efficient as an organization, how we can defend our position in the marketplace. Because now with the advent of all of the technology that's available, if you have an idea, no matter how brilliant it is, if you take it to market, a handful of people know about it, and there's any sort of meaningful traction, I can guarantee that within a month's time, 2 months' time, short period of time, there's going to be a lot of people who are going to copy your idea and try to do it better than you. So for us, we spend a lot of time understanding where the hurdles might be, where we might hiccup down the road, and then ultimately how we can help the entrepreneurs and ourselves defend the position for whatever category we're trying to dominate.
That's awesome. That's great insight, Ian. So we're having new people join. Thank you for joining. So that's why sometimes I'm trying to mute the new people joining because it's doing noise. But so I think, if anyone has any questions, feel free to put it in the chat. We're going to move to the next question here. Oh, there's a question here. How many points do you need to know when an entrepreneur have a good idea or great innovation? So
thanks, Ronnie. That's a good question. So a lot of times you'll hear people, business, investors, businessmen, et cetera, talk about a white space, right? So an area that has been identified where there isn't a lot of competition. And a white space can be a good thing or a bad thing. And I'll take you, just so you guys can understand an example of a good white space versus a bad white space. You can think about a matrix that has, four quadrants. And I'm going to take you to a CPG reference. So consumer packaged goods, hair care, body care, food, anything that you can essentially buy at a grocery store for the most part, in the center sections. And I'll take a very specific example. We'll take men's grooming, right? And this is a space that's very competitive, but it's a very big market, so there's a lot of people trying to tackle it. What you'll find in the men's grooming space, and you can do this exercise with any industry. So whatever you're thinking about, whatever you're working on, you can use this methodology and apply it to whatever it is that you're working on. And Ronnie, remember, this is, sorry, Alistair, go ahead.
Is the CPG matrix the methodology?
Correct.
Okay.
Yep. So, and Ronnie, this is gonna add to your point, so you can understand. This is gonna sort of answer your question in a couple of different ways. Because the number one thing an investor is looking for when you present to him, above all else, is not only how he's going to make money, but how he's not going to lose money, right? So everything you do is essentially to address that point and make the investor feel comfortable. So bringing it back to the white space. In the CPG space, specific to men's grooming, there are four types of brands, and there's four quadrants, right? So you've got high priced, you've got low priced, you've got big, bold personality, and conservative personality. In the lower left quadrant, you've got cheap with a conservative personality. So inexpensive, conservative personality, right? There's a lot of people that play there, very difficult space to address. And mostly very big companies, Dick, Schick, Gillette, etc. That's where they play. Then in the upper quadrant, you've got bold personality, but inexpensive, which is where Harry Shave plays, Dollar Shave Club, Bulldog Shaving. There's a lot of people addressing that. Moving over to the right column, you've got bold personality, high price. There you start to see fewer players, right? To the further right, there's less high-end men's grooming brands that are successful. Now think about this on a matrix. You start to see a white space in sort of the conservatively priced, just moderately priced bold personality. And then in the bottom right quadrant, you have bold personality, conservatively priced, right? So cheap, expensive brand with no personality or conservative personality. And nobody plays there. So there's a white space there, but there's a reason why there's a white space there. It's very, very difficult to sell a brand for a lot of money that doesn't have a big personality. Because what people identify with are essentially three things: convenience, quality, or price, right? So you want to hit one of those. So that's a white space that you don't address. The other white space is the one I just described, which is on the top of the quadrant, where you have a moderately priced brand with a big personality, and there's not a lot of people playing there. So I always look for a white space, and if an entrepreneur can show to me, here's where we fit in the bigger picture, and here's why there's an opportunity. That's the number one question that can really, one, it lets me know that the entrepreneur thought about how they can have a competitive advantage. Two, it shows that there's something to tackle. It shows that there's something that hasn't been addressed yet. So whether you're competing on price, quality, efficiency, convenience, etc., think about that as you're putting together that quadrant that will identify the white space in which you're going to address.
Okay, so the CPG matrix is a method. I'm pretty sure people can Google it, right?
Yeah.
CPG matrix, and then use this as a good tool. Thanks, Ian. So let's move to the next question.
Yeah.
So then, so this one we covered it. So how should an entrepreneur approach you or venture capitalists? We touched base a little bit on it in the earlier discussion, but we have new people coming in there. So how would an entrepreneur connect with a venture capitalist? What's the best way, the best approach, and how to proceed?
Before you reach out to an investor, you want to make sure that they're interested in what you're doing. That's the first step, because you could reach out to 50 investors, but if you reach out to 50 tech investors and you're trying to develop an almond milk, you're not going to get any response, right? So make sure that you vet the investor. Make sure that they're interested in the category in which you're playing before you reach out. Once you identify that they're interested in the category that you're trying to build a business in, go at it with 110%. Until they say no, you don't give up. Assume that they didn't see the email. Assume that they didn't get the message. Venture investors or investors in general, they don't intentionally avoid emails or avoid responding people. The reason, what investors look for is opportunities that interest them. Persistence interests them. They understand that what it takes to be a successful entrepreneur is a level of persistence that cannot be explained unless you actually get out there and do it. So, that's my best way to do it. If you send me an email, for example, and I don't get back to you, it's not a personal thing. It's not because I don't like the opportunity. It's not because, because I don't like the way you look or something. It's just reach out to me again. If I see the same person kind of like hitting me up in the inbox a few times, I'm gonna say, hey, look, this person is passionate about what they're doing. It's worth giving them a shot.
Great. So persistence is the key. You mentioned it already.
Yep.
So you're reaching out to investors. Basically, it's number one, contact investors that are interested in your market, in your ideas, and then make sure you send emails, and because they're gonna see persistence as a point for you. If you send 20 emails, it's gonna be a good sign, because it means you believe in your idea, you want to make it happen, and you don't give up, basically, right?
Absolutely.
Great.
That's so important. I mean, I've emphasized it a few times, and please take that, listen to that. Persistence is important. In retrospect, let's say you do persist and you end up getting an investment and your business builds. Looking back, you're not going to regret being persistent. What you'll regret is that if you don't engage with the investor, or if you give up on the opportunity. I think the number one thing an entrepreneur who's really committed to being an entrepreneur should fear is regret. And if you can use that as a guiding light in entrepreneurship, it'll take you far. An investor isn't in your life right now anyway. So if an investor doesn't like what you're doing or says no to an opportunity, it's no loss to you. You didn't know them before, you don't know them now, and maybe you'll run into them down the road, but they'll respect that you reached out, and if they had the opportunity to say no, that's okay. That's part of the gig, but you never know until you try. Yep.
So we have questions coming in there. Yep. This is creating a lot of discussions that it seems. So we have a question from Ming, and Ming is asking which risk level for a VC should take. So which risk level, how do VC gauge what risks they want to take? How do they identify the risk?
Yeah. Risk is it's a funny thing. There's a lot of ways you can look at risk, and the way that an investor can gauge risk is a variety of different levels. This sort of goes back to what I was saying about approaching the right investor. There's some investors that are category focused that only invest large amounts, right? So a risk level for an investor who writes, let's say, $5 million checks and only invests in Series B and beyond, the way that they look at risk is different than an investor who invests in seed stage opportunities. Typically, a venture investor who's investing mostly in venture stage or seed stage companies will place a lot of small bets in a lot of different companies. The firms that typically make larger bets will take more concentrated positions, i.e. more risk, in larger businesses. So when you're approaching an investor, it's good for you to know, who have they invested in before? How much did they invest? How many companies have they invested in to date? And what the relationship looks like. Because when you engage with an investor, you're also taking on risks. Risk is the assumption that in the future something could go wrong, and the potential for a capital loss may be present. So there's risk on both ends, and you as an entrepreneur can mitigate your risk by being very clear before going into an investor meeting who they are, what they're about, how they invest, how much money they like to commit, and then you look at if you can get a sense of what their portfolio looks like. The kind of businesses that they tend to gravitate towards, so you can be educated on that, and that will help your discussion with them.
So question to follow up on, how do you find that information? A more tactical, question. So how do you find information, about where is the investor investing?
Mm-hmm. So a lot of times, a simple tool, if you don't have a lot of money, there's a lot of tools that you can go out and pay for, and you can get access to investor databases and whatnot. An easy way to do it is simply a Google search. If you are looking for capital in something specific, you Google search, hey, investors in this space, right? Investment firms who invest in X. Typically, you get on that, and you can just run through them. Another way to do it is to network. I think that there is so much value in actually meeting an investor face to face. A lot of times with me, if it's something that we can't give a lot of time to, I'll always try to make a recommendation. So for an entrepreneur, if you get a no from an investor, they say, hey, this isn't a fit, follow up with something where they can actually be helpful. Say, hey, I know this isn't a fit for you guys, but maybe you have someone that you can refer me to where I can continue the conversation. A lot of times they'll give you a referral, and they'll point you in the right direction. So there aren't any, in terms of readily available, there aren't any. I shouldn't say there aren't any. There are a few free databases, but a lot of them are regionally specific. So, if you're looking for investors in New York, you can look into the New York Venture Capital Association, and there's little groups like that all over the place. But you really have to get yourself to the investor's website, and typically they have, portfolio metrics, what they're looking for in a deal. What their portfolio looks like, who they've invested in today, the philosophy of the fund, the firm, how they like to work, and then what kind of brands, they work with. Yep,
great. So Ian, we have more questions there coming in. So so that's Ryan. So he's an entrepreneur in the medical space. What kind of info for an initial contact? What would be the first information? An email sent out, or first contact? What's the information, current?
So if you can get a warm intro to an investor, it's always an easier way to get in front of them. If you can find a mutual contact, someone where there's a friendly relationship, that's the first way to go. And if it's just a cold contact, it's going to be a little bit more difficult. The best thing you can do is construct a nice email. It says, hi, essentially, hi, I'm an entrepreneur. I've got this idea. Here's what I'm working on. Here's a deck that explains it. I would love to talk to you about it. I think that what we're doing really aligns with the focus of your firm, and you would find it, worthwhile to take the time to learn about that. Being straightforward, honest, taking a very, I think, down-to-earth approach to an investor is respected by everybody.
Yeah, so no fluff, and no, this is the greatest idea.
No.
Straight to the point.
Straight to the point.
Yep.
Yeah. Don't, if you tell an investor, I've got the best idea ever, and in this could be the next Facebook, and it's going to say that the way that you're thinking about this is a little bit, your idea is a little inflated. let the let the investor decide that you have the best idea, right? And if you do, it'll speak for itself. But if you set the bar that high, it usually comes off as a little pretentious, and you know, it's hard to work with that.
Yeah, thanks. So then another question from Steph. So how do you even determine the full scope of investors out there in your field? Is there a particular resource you recommend for locating investors? So I think we've answered that question. Correct, Steph? Did you get the answer you needed there? I think Ian covered this. Cool. So I'm going to move to the next question on the slide there, and everyone feel free just to jump in and ask a question. So how difficult is it to get funded, and what is it you would be looking for? Venture capitalist is looking for the type of documents maybe, and the interaction and what he wants to hear.
So I think this gets back to the question of, understanding where your value is and what your business does. Setting your expectations early on as an entrepreneur are very important. You have to know who you are as an entrepreneur before you can really go out there and raise money, build a team, launch a business, plan, etc. So what I say is showing that you have a good foundation for your business and for your concept is probably the most important thing you can do. Going through the motions of understanding what components of the business you're going to need in order to hit your growth targets, and showing the investor that you've gone through that exercise is, I think, the most important thing you can do. If you're building a business that is revenue driven, so you want to launch an app that that sells subscription, right? And investors are going to want to see the financial model for that, and then you have to support why people are going to subscribe to it, how the margin's going to work, and if you have a month, a quarterly growth rate of a certain percentage, or a month over month growth rate of a certain percentage, that has to be supported with qualitative and quantitative evidence. So if you go from $100 in sales let's say in January to 10,000 in February, that's based on an assumption. The investor's not going to look at that and say, oh, wow, that's a great opportunity. I really want to get involved. He's going to pick it apart, and he's going to say, how do you jump from 100 to 10,000? What money is spent to get from 100 to 10,000? Who's involved? Who are the players? Do you have the infrastructure? All of those things. So this gets back to setting the foundation for the business. Make sure you take your time on setting up the foundation. If you're going to build a foundation for a skyscraper, you need to build a deeper foundation. If you're going to build a foundation for a 3-story house, you have to build a foundation for a 3-story house. So just think about that early on, because the more questions you can have answered when you go to talk to an investor up front, the less questions he has to ask, the better off you are.
Yep. So a question. Thank you, Ian. So a question just came up, from so how to come up with an exit strategy.
Mm-hmm.
And is this something, so I would add something to that question. Is it something, that venture capitalist wants to know immediately? If there's a venture capitalist, at what stage, is the exit strategy discussed?
Right. So this also ties back to what my last point about sort of setting your expectations for what kind of entrepreneur you are. There are some entrepreneurs who don't have the intention to exit. There are some people who want to build a business and sell it for $500,000, and they're happy with that. And then there are some people who want to build a business and sell it for $1 billion. So understanding the foundation of your business and really where you want to take it is going to influence your thought process about an exit strategy. I'll give you a case here that you guys can glean from. We have a company that we're looking at right now who has been very clear about the fact that they want to exit their business within the next 5 years. They're 3 years old. which means that inception to exit is 8 years. And they're very direct about that up front. What they've done to prepare for that exit is they took 3 potential acquirers and they said, here's where this company, it's a big company, is in need. And this is where we can develop something that they could never do internally, that it would make a lot more sense for them to buy us than it would be for them to build it, right? So they planned for that exit, and they went out and they hired a bunch of senior level executives who had used to work at those companies, who understood the process, who understood the procedures, knew how to take the company from 2 million in revenue to 30, and that's how they prepared for their exit. So when they get to year 8 essentially, and they're tracking to plan, revenue targets, growth targets, all those things, they're tracking to plan. They're going to be at a point where they're a perfect fit for one of the strategic that they identified to acquire them. In the tech space, for example, we have a company now who saw, and I'll just tell you guys this straight up, they saw that LinkedIn users, 93% of LinkedIn users were over the age of 23. So they said, well, the career, the first time hire, the career market is shifting. The way people are hiring and getting work is shifting. Younger individuals don't have a source to just go, to align themselves with career opportunities, to companies they want to work with, etc. The first time hiring process is completely inefficient. And there's also no place for a young career-minded individual to go to begin to build a professional profile in an environment that's comfortable for them. So essentially, what they've endeavored to do is go build a LinkedIn platform for 16 to 23-year-olds, right? Which is an incredible opportunity because every marketer on the planet is looking to glean data from that cohort. It's tons of purchasing power. There's a lot of growth there, and it's all data that nobody seems to be able to capture because it's such a unique set of people. They have a very clear exit. They want to go to LinkedIn. LinkedIn has said we want to be the dominant. We want to dominate everything career and education in the online cloud-based ecosystem. Right there, they identified something LinkedIn needed. They built a business, or they're building a business, and they know their exit. At some point, LinkedIn might be the acquirer, but what's happening in big tech right now is that there's offensive and defensive purchases. So, for example, LinkedIn could make a bid and say, I want to buy that company for X. But Facebook would say, well, that customer is just as valuable, if not more valuable to me than it is to LinkedIn. So I'm going to put in an offer, to combat LinkedIn's offer. And you have a really interesting environment that is really jacking up valuations of early stage startups, because the value of a user, not just the revenue, but the value of the data that they can get from that one person is immense. And that's how a lot of these valuations are coming to these days. It's not a revenue or EBITDA valuation, it's a user valuation. So those are 2 examples of how you can kind of consider strategizing for an exit.
So this is a really good insights, Ian. Thank you very much. So an additional question, when you have an exit strategy and you've identified your acquirers, what's the process to get known by those acquirers? Are you straightforward with them? You make yourself known? So how do you get their attention?
So if you've planned accordingly, it's highly likely that your potential acquirer already knows who you are. So there's 2 ways to go about it. You can, take the traditional route, which is you go to an investment bank, and typically at that point you'll have had an investor who's invested considerable amount of money into your company and can sort of lead that process for you because they're looking to redeem some of their capital or recapitalize their equity, take the money back. If you're a lone entrepreneur who doesn't have any outside investors, you can contact them directly. A lot of people, for the most part, are fairly accessible. You can find people on LinkedIn. You can find contact information online. If it's a public company, the executive board has to make their information publicly available. So there's a number of different ways, and I think getting creative with it at that point is is the best approach. Investment banks typically, if you're going to sell your company through an investment bank, they're going to want a big fee. But if you're weighing that against the value of your time, sometimes it's worth it. If you have a direct line of contact into a potential acquirer, there's no reason to go to an investment bank. The value of an investment bank, though, I will say, is that when you're selling a company, you've got parties that have, you could assume that the parties have different interests. They want a lower price, you want a higher price. There are legacy issues to discuss. What are they going to do with the business after they buy it? Sometimes people buy companies just to shut them down, just to take them over so that they don't exist anymore. And for an entrepreneur, sometimes that can be, that's terrifying. The idea of selling your business, then you've got all this money, but the company that you spent all this time creating doesn't exist any longer. Sometimes that's not worth it. I mean, there's tons of tales out there. You can look them up of entrepreneurs who saw that happen and it was devastating for them. So getting clear about what the plan is and how they're going to operate the business, what they're going to do with it after they purchase it, getting the right price for the business, feeling good about the transaction. Those are all things investment bankers do help out with, and you can find value in that. And I would say a lot of times it's worth whatever fee that they do take from the deal.
Great. Thanks, Ian. Thank you. So I'm going to move to the next question.
Yeah.
What is the value add that a VC firm, so it's often debated, and so what's the value add of a VC firm?
It's a really good question. There are some VC firms who add no value, and there are some VC firms who add a lot of value. And value is relative. So you have to ask yourself, yes, I need money, but aside from money, what else do I need? Do I need help with distribution? Do I need strategy help? Do I need a mentor? What do I need? And when you meet with these firms, you set up meetings, you get in front of them, you're going to find out very, very quickly what the value add is of that particular firm. So going out there, understanding that the range is pretty wide. There are people who add no value. There are some people who micromanage. There are some people who are hands-off, but will allow you to tap into their networks as you need them. And then there are some people who will completely operate the company side by side with you. And I think as an entrepreneur, you want to identify what your needs are and feel good about the relationship. Taking it back to what the first thing that we discussed, you are taking on risks when you sell part of your company. You're giving away equity for cash. In hopes that the business will grow because of it. So it really does take sitting down with them, getting to know them a little bit, asking them questions, making sure your philosophical alignment is intact, making sure that they believe in the business as much as you do. If you sit down with them and they say, we can add a lot of value, and then you actually start to flesh it out and they're thinking of taking your business a whole different way, maybe they can add a lot of value, but maybe just not for you. So it's very important to identify that up front and know that VCs can add, can come in and help you operate. They can bring contacts. They can help you distribute. They can help you network. They can invite you to events. They can write you a check. There's so many ways VCs can be strategic, but culturally, it's important that they're a good fit for you, and that after you meet with them 2, 3, 4 times, you guys are speaking the same language. If you have an inkling of some sort of internal resistance and something that says, "Oh, I really want money, but something about this isn't a fit," take the time to sit back and think about it, and really give it some consideration, because there's a lot of money out there, and there's a lot of investors. And although if an investor does make you an offer, it's very enticing to say, "Oh wow, there's capital on the table. I really need this. Let's go after it." But you can find that if that decision isn't made very conscientiously and very thoughtfully, it can wreak trouble down the road. So.
Yeah. Thanks, Ian. And we can clearly see, that you know a lot about all this, and I can imagine that you can add a lot of value to any startup entrepreneur there.
I hope so. We try to have fun with it. I mean, that's the other thing. It should be fun, right? Starting a business should be exciting. And, you know, you want an investor who's just as excited as you are, who's like, hey, let's go out there. Let's do this. Let's be a team. You know, let's put our egos aside. Let's work on this and let's make this happen. And that's how I see it. I mean, that's how I want to invest in companies and entrepreneurs that are excited about what they do and love what they do, and you know, and we speak the same language. So I would hope that, and is advised to all the entrepreneurs on here now, make sure that you align with your investor. You know, it really is a commitment. So make sure you guys are on the same page.
Yep. So it's a real connection, right?
Yeah.
For a long journey. You know?
It's a long journey. It is. I mean, it really is. It's a marriage. So you got to have that gut feel, you know, you got to feel good about it.
Yep, absolutely. So next question. So how does a venture capitalist, so we can imagine, a venture capitalist knows really the market, what's going on, and entrepreneurs on their side, often they also need to do market research, know about the market. So do you have any tips for, entrepreneurs of how to stay abreast of the market?
Yes.
How to, conduct a good market analysis?
Yeah. Making it a habit. Two things. The first thing is, don't let your mind focus on anything that isn't important. There's a lot of things that are distracting in this world. There's a lot of things that, your mind will keep, negative thoughts that your mind will keep going back to, and things that just don't add value for you or your thought process or your strategy. And the reason why I say that is because we all only have so much mental capacity and so many hours in a day. So if you spend even 10 minutes a day focusing on something that isn't doing anything, that's not of value for you, that's not making you smarter, that's not helping your business, you're wasting 70 minutes, you're wasting an hour or just over an hour a week just thinking about nothing, basically, right? That you could be learning. So that takes me into the second point. Standardizing your education on a daily basis, making sure that you make it a routine to wake up, to get tabs, see what's going on, see what's happening, making sure your mind's working, talk to people, so you can build a consensus in your own mind, document the information, and then test it. Take some time at the end of the week to look back on what you've heard, what you've read, what you've thought, and ask yourself questions about it and do a little research on it. Make that a weekly thing. And what you'll find is the amount of information that you can understand is incredible. But it's up to you to make the time for it and really give it that thought. So for me, what I do is that I do just that. I meditate, making sure that my mind is clear, that I'm thinking about things in a very objective way. I try to take my own subjective opinions out of things because it also, I think, creates a convolution of distortion within your head if you're only thinking about it from your angle. So looking at the bigger picture is very important. And then talking to people, having a sounding board. There's a lot of raw data out there that comes out, and a lot of it is also subjective, right? People post things that say, hey, this is what's going on in this industry, and this is what's happened, and this is how I look at a deal, and here's what M&A trends look like in this sector, and all of those things. It's up to you to take that information and distill it within your own, within your own thought process, with your own psychological strategy. There's so much out there. I mean, every individual is so privy to so much information. So making sure what you're consuming, what data, what articles, what websites, all that stuff you're consuming is relevant to your business and what you care about.
Thanks. So it's basically, data, raw data from the web, from, newspapers, and also people.
Yeah.
Maybe trade shows, maybe conferences and summits or whatever.
Yeah.
And
because you think about it, like every investor, we're all reading the same stuff. There's not some secret source of information that only investors can read, for the most part. All the major headlines, all of the industry news, that's all, 99% of it is publicly available. So, and even the 1% that's, that is only through subscriptions and whatnot is typically some sort of spin or some sort of regurgitation or a different look at what's already publicly available. So you can assume that any information that any investor is getting is information that you can access as well.
Yep. So I'm just looking at the time. So it's 8:26. So we have 3 minutes. So I'm going to move ahead with the question. So we've covered this. So also, everyone on the call, make sure, if you have a question, feel free to ask a question. We have a few minutes left. So this is your opportunity.
Mm-hmm.
So here's Ryan is saying, so Ryan is putting a team together, and he's saying a team is really important. What does a successful team look like, and what are the essential of the team expertise?
I think this is this is the most important point, after persistence. The team of any company is the most important component to any idea. What I say is, you can have the worst, job in the world. If you have the right team, you guys will enjoy it and be successful at it. Conversely, you can have the best idea in the world. If you have the wrong team, it will never get off the ground. There's a couple of different ways you can look at a successful team. The first, I think the first component to a successful team is understanding the needs of the business. And we need to identify the needs of the business, and there you can build the team around it. Culturally, it's important to understand you guys are on the same page. Typically there's one founder or there's a co-founder, a founder or, a founder and a co-founder. And then there's people built around it. Taking this back to this foundation that I was talking about before, the team sets the precedent for the foundation. Making sure that you, one another, respect each other. That egos can be taken out of the equation, that you can look at the business objectively. Making sure that early on you guys are clear about where you want to see the business, headed. What the goals are, aligning those interests. You really have to be a yin and a yang. There has to be a balance. Salt and pepper, yin and yang, peanut butter and jelly, right? Just to put it plainly.
So, and I have a question of what you said, on the team. So what about, leadership? Do you need to have a clear boss from the get-go? Who's the founder, who's the decision maker? Or is it okay to sort of have 5 people being the bosses,
No. So there needs to be a leader. In my experience, if you have a team of, if there's 5 people who all sort of work together with no clear leadership, what you end up getting is a slow-moving organization. Ultimately, leaders will emerge, right? If there's a leader, the leader will emerge. And the best leadership, in my opinion, leads from behind. They're supportive. They make sure that everyone's on track, but they do it in a way that, that encourages the team. They set direction. And naturally, the people around the organization will look to that person for guidance. You look at let's just take sports as an analogy. You have the best football players in the world, right? The best in the world. There's no football team on the planet that doesn't have a coach, right? There's no successful organization that doesn't have a CEO, right? You need somebody to look up to. You need somebody, for an answer. You need someone to set the direction. And ultimately, it's that person's responsibility to give you guys the tools. Sorry, if you're the entrepreneur, it's your responsibility to give your business and your colleagues the tools, the inspiration, the thought process, etc., that they need to succeed. And I know that time's sort of running here, but I wanted to say as well, as an entrepreneur, there's an interesting sort of uncomfortable transition that happens from when you first conceptualize an idea to when your business gets off the ground. First, you start a business for yourself, right? You have an idea and you say, I want to get out of here. I want to do something fresh. I want to do something new, and I want to do it for me, right? And as the business grows, you have a short period of time where that's the case, where you're doing your own thing, you're doing it for yourself. What you'll find is, although that's going to continue to be a driving force within your own psyche, you have to transition at some point. And a lot of entrepreneurs have a very difficult time transitioning from being, self-driven to being a leader. And when you're a leader, your responsibility completely changes because you become a servant to your organization. People look up to you. They want answers. They want direction. They want all those things that I just explained. So then all of a sudden, you're not putting yourself forward as much. You're putting everyone else before you. And it's a radical change. It's essentially from when you found the business to once you're at 5 employees, you're already, ready to serve. You're ready to lead. You really have to make that transition at that point. So understanding that will happen and identifying, hey guys, or hey, me, entrepreneur, I did it. Moving, it's valid. The concept is validating. People believe in me, in my concept. I need to make sure I'm giving them what they need to succeed. And ultimately, if you do that, you will succeed.
That's great. That's great. And I've seen many entrepreneurs, having co-founders, or even a group of 3 entrepreneurs where they all, sort of the thinking, they're the CEOs, and this then with the egos, it creates issues. So I think it's a question to you, Ian. What do you think? Is it better and one of them steps up and says, okay, I'm going to be the sort of a leader? Because do you need that one person? And have you seen successful teams, with several co-founders and everyone wants to be the CEO? So how to manage that type of situation?
I think that there's a fundamental flaw in the organization if you've got 3 co-founders who all want to be a CEO. I would never invest in a company that has 3 co-founders that all want to be the boss. The team is so important to me. I've been in some situations where there's disaster, great opportunities, great companies, but the team just didn't work. And it usually came down to having too many chiefs in the kitchen, too many chefs in the kitchen.
Yep.
And in entrepreneurship and in business, that's a phrase that's used a lot because it's so true. The best businesses have a team where everyone respects everyone for what they do, and what their respective position in the company is. So as a CEO or as a leader, you respect your chief of marketing, you respect your director of operations, and then they respect you. So although you can be a chief in whatever vertical or whatever area of expertise, or wherever you're whatever category of the business you're owning, it's very, very difficult for there to be a co-founding team where 3 people want to be the leader. And I would advise you, if you're starting a business and your business partner wants to lead and you want to lead, and you're seeing differences of opinion right off the bat, and you're starting to see your relationship go in separate ways, to address that very, very early on. Don't let that spin out of control, because it will.
Yep. Thanks. So I think we're running out of time. So what I'm going to do is open it for question for the audience. And maybe what we can do, let's try, unmuting people. We'll see what this goes, so that people can talk, a little bit, and then talk directly and interact with you, Ian. So Demetrius, you unmuted. Derek, you unmuted. We'll mute back Derek. Ming, you're unmuted. Nikhil, you're unmuted. Yeah, it's not working very well, so I'm not gonna do this. So does anyone has any questions? And feel free, I think people, everyone, you can unmute yourself on your own. So if you have a question, just unmute yourself, and Ian is there. And as you've heard, it's very hard to have VC FaceTime. So thanks for Ian for being here. So make the most of it. It doesn't happen often.
Yeah, feel free to ask away.
Thank you very much.
Yeah, absolutely, no problem.
Actually, I have a question.
Yeah.
So for most of the VCs, do you require a detailed business plan at the very beginning of the project? Because I know sometimes the plan might be changed, but usually would you consider a detailed business plan?
Yeah. So, the days of a 35-page business plan are sort of a thing of the past at this point. For an investor, what they're going to want to see is basically an executive summary to catch their interest. At some point, you're going to want to flesh out a full-fledged plan, and it's better to have that because essentially what a business plan is it shows you and it shows the investor that you've taken the time to really understand how you're going to get this business from point A to point Z. Right? It's not just for lip service. It's not just to show that you have a business plan because people say that you should have a business plan. It's literally for showing the investor that you've taken the time to go through every component of the business, every thought process that would have to be brought to light in order for you to hit the goals in which you're proposing you'll hit when you pitch it to an investor. So make sure you have an executive summary. Make sure you understand your business. Make sure you understand why you're doing what you're doing. And if you have a very clear sense about that, get it into an executive summary. Lay out the opportunity, what the upside is, what the potential risks are, who the competitors are, and all those details around the business. And you can do that in 2 pages essentially. No investor is going to read through a business plan. I promise you that.
Okay. Yep. Thank you for your answers.
Okay, so anyone has any more questions? So Nikhil is asking for Ian's email or contact.
Yeah, I'll just send it. If you guys have any thoughts, I'm going to just type it in here and you guys can just shoot me a note.
Thank you. Any other questions, everyone?
Ronnie just asked, which is the best way to test my... Ronnie, what's your idea?
Ronnie? So let's see. So any more questions? So we have also Alex just joined. So Alex, if you hear us, I think you just joined. So the event is running, to its end, but it's being recorded. So you'll be able to view the recording of it.
Yeah. Sorry, I'm going to try to do this by my best English accent. What do you mean by what is my idea?
So what market is it in? So it'll give me a better context to help you tell you how to test it. If you just, is it in fashion? Is it in food? Is it in tech?
It's about sports.
Sports?
Yeah.
Is it technology?
No.
Okay. So understanding your market obviously is really important. If you understand the market well and you understand the customer and what they're looking for, then you can figure out how to test it. The best thing to do is to actually get out there and do some small testing. A lot of people will say, oh, you need 500 people, but no. The best thing to do is tap your network. If you've got an idea, reach out to 5 people, maybe that you don't know directly, but maybe you know them through friends or through family or whatever, and run it by them and say, hey, look, I'm working on this. What are your thoughts? Whether if they can actually test the product or try the app or whatever it is that you're building, the most honest feedback you're going to get is if you can get your idea out there outside of just close friends and family. So get it one step beyond, and you'll know very quickly whether or not it's a viable concept. People will give you feedback, etc.
Okay, thank you, Ian.
You got it.
Thanks. Any more questions? So here we have Ming. My plan is evolving, could continue to be refined. When is the best time to launch my business?
Now.
Now.
Yeah. The best time to launch a business, you could hold on to a thought for a long time. Ultimately, you just need to go out and do it, and you'll learn along the way. There's, everybody that's ever started a business never knew what was actually going to happen. Businesses are started, and by the time you get to where you're going, a lot of times it's different than what you expected. So your best shot is to just go out, take the first step forward. You might trip a little bit, but you're never going to know where you can go unless you take that step.
That's really good advice. So any more questions? We're in Q&A. The webinar has been recorded also. So for Alex.
Yes, I've got one, Alistair. Is it better to start big or to start small and have time to refine the business?
Yeah. So it's always better to think big, start small. Know that you have a big goal, a big dream, a big vision. But you eat a steak one bite at a time, ultimately. And you got to think about it like that, one step at a time. When you hear people say, I'm building a business or I'm aspiring to build a business, it really is building a business. You're building something from the ground up. So you have to take, prioritize your time, making sure that you're getting things done. You have milestones that you set to achieve and work against those. If you look at a year's time and you look at everything that could happen over the course of the year, it can be a very daunting, very anxiety ridden, thought. I mean, it's just, there's so many things that can happen. So if you lay it down, break it into achievable milestones where you're doing a little bit, you'll look back over the course of, a month or 2 months or 3 months, and you'll have achieved a lot.
Okay, thank you. Okay, great.
So I have a question.
Yep.
So you see a lot of things, right, in the job you're in. What are the major trends you would say, for 2016? What are you seeing? Are going to be some of the trends? In terms of booming technology maybe, or booming businesses, or major trends?
Yeah, so I mean, major trends, obviously, and this isn't for me, but the drone space is very interesting. Obviously, there's a lot of opportunity there. There's some incredible technologies. I think collaborating or connecting different industries, there's a lot of opportunity there, and there's nothing that I can pinpoint per se, but because of all the technology that's being developed, there's ways that we can integrate industries that have never been integrated before. So looking at it broadly, the creativity between the interactivity of industries, I think there's huge opportunities. And you can take, just for the exercise, you can take two different industries that maybe are completely different and figure out a way to make them work together. And you can find an opportunity there. I think that's really interesting. The other one that's really big, pertinent to us right now is, in the food space, there's a lot of what we're calling healthy alternatives, where, people are taking traditionally unhealthy foods and making them extremely healthy. Fairly low, low barrier to entry on that. You can develop it in your own kitchen, most of these things. And if your idea is good enough, there's a lot of people out there willing to help. Let's see, what else? Financial technology, so much to be done there. Very, it's a tricky industry, but so much innovation happening in fintech, which is creating some great opportunities for people to get in. And what else? I think those are right now. Those are probably the three major, the three major things that we're looking at.
Okay. So, any other questions? So, everyone, so just one second, there's a note there. Okay. So everyone, do you have any final questions? Because everyone's time is precious and valuable here. So, and Ian, do you have anything you want to add? Anything you want to add?
No, I think, if you got an idea, the best thing I can say is you got an idea, you go out there and do it. Don't take no for an answer. Make sure you do your research. Make sure you understand that your opportunity is viable. And once you do, you just get out there and make it happen. There's going to be a lot of resistance. It's going to be extremely challenging. People are going to tell you no and that your idea can't work, and that's just part of the game. You have to understand that that's just the nature of being an entrepreneur. But, believe in yourself, believe in what you're doing, be smart, be respectful, be honest, be truthful. And if your idea is good enough and you're persistent enough, you're going to make something happen for sure. And if one idea doesn't work, it will spawn relationships, other ideas that could potentially work. So always be looking for ways to connect those dots.
I think that's a perfect statement to end the webinar.
Thank you, guys.
Yes. Thanks again, Ian.
All righty, guys. Take care. Thank you.
Thanks. Bye-bye.